Good morning and welcome back to Almus Market Mornings. We start the week with the backdrop of a very interesting payrolls number that emerged on Friday. NFP, which was broadly expected at 80,000 jobs, was negative 23,000. Now, this has ingrained fear in people's mind that maybe it's not just inflation, but Fed will be sensitive to the week's job number as well. And consequently, the odds of a September rate hike has been pared down. In fact, what I found interesting is that despite a bad payrolls data, we saw unemployment rate come down to 4.1%, which seems strange. Apart from that, we also start the week with fears of tariff. US Senate has passed a bill that will allow US to impose tariffs of up to 100% on major buyers of Russian oil. Majorly, this will impact countries like China and India. Good morning, JK. First, would like to ask you to decode the NFP number because this was a shocker. How do you actually make sense of the unemployment rate alongside this?
Good morning, Swaraj. I think it was a weak number in most respects, in all respects, in fact, because the job creation obviously negative number while 80,000 was expected. And the what stood out was further revision to previous month's numbers, and that was a 103K downward revision to past 2 months number. Now the 3 month average employment is around 20,000, and not long ago it was around 70,000. Okay, so that's a very low employment rate, or employment rate, I would say, because so far the indications last week from either job openings data or ADP, and then the job cuts, all of them were giving mixed indication, and there was a sense that the employment situation is stable, low hire, no fire kind of situation, but not concerning. But now the employment is down to 20,000 average for 3 months, and then wage inflation is substantially down both on month-on-month basis and the year-on-year basis, which indicates that the negotiating power of employees is lower. So the demand for low employment is also lower. Now you talked about the unemployment rate falling to 4.1%, but that was not for good reasons. It was primarily because of further drop in the participation rate. Now, the participation rate means that the number of people who are registered themselves as unemployed has come down, which obviously means that unemployment rate comes down as well because the job creation is same. So nothing to rave about the unemployment rate coming down. So overall, it is a weak number, and therefore, given the overall softer number, though the other statistics suggest that it is stable job market, the report actually suggests that the labor market is not a source of inflation, which means the Fed has less urgency to hike rates in September. So one source of inflation is actually now down. That is wage inflation or tightness in the labor market is down. Now it is the oil and other measures of inflation which the Fed will be looking at. And we have the CPI and the PPI number this week, which will provide enough inputs for Fed to assess. But if you look at the rate hike probability for September, which had once read nearly 70%, has dropped substantially. The two indicators, that is the LSEG's indication, that is the Reuters-based indication, is that 39.6 probability of a September hike. CME's FedWatch tool indicates 45% probability. So this was in fact 55% before the data actually. So overall, the number was not encouraging for the economy watchers. So we'll have to see how it evolves going forward. But yes, the rates market was happy about it because the yields came off, particularly the front end, that is a 2 year, came down drastically by 8 basis points. But subsequently, the yields also went up. Yields for 2 year went up to only 4 basis points negative. 10 year was just 1 point negative, and 30 year was back to where it was before the data. Now we have been talking about the yields being driven not just by the inflation or the economy situation, but also majorly because of the fiscal situation in the US and the Another important thing that is also to be looked at is the new issuances of almost 130 billion that the Fed, that the Treasury has to handle this week. So it's the demand for the treasuries which is driving, or rather the lack of demand relative to supply, that is driving the yields higher in the US, and that's quite concerning for the US government and the treasury also. So it is in this context, when they intervened in yen, it was through euro and not through dollar. So nobody wants to, rather the authorities don't want anyone to sell their dollars or sell the treasuries to raise dollars, and that is where the yields are to be looked at, that unlikely to come down substantially until there is some sense that fiscal or the debt situation is being handled in some way, but there are no clear signs about that as well. In the Gulf situation, there is not much of a progress, although we have been hearing about the deal which is worked out by Oman with Iran may come through. But so far, there is no direct negotiation with the US. There is no indication from the US that the terms of Iran are being agreed to. Both sides are sticking to their main demands. US wants the full stoppage of any enrichment, and allowing US inspectors to visit the sites and ensure that there is no enrichment going on, and the freeing of the Hormuz Strait. On the other hand, Iran wants full lifting of the sanctions, release of the frozen money. These are very severe conditions. Both are not really very easily agreeable for either party. So that is where the stalemate is, and the market is watching where this goes, because the more days the shipment is affected, we have the stress on the oil price, because as we have shared earlier also, the strategic petroleum reserves are much lower now, and there is nothing to fall back upon if there is a re-escalation and the Hormuz Strait is fully closed up. So market reactions wise, the bond yields went down and came up. The dollar also came down once again. It's making a baby step down now. 99.50 was broken, but then it's been holding on. And now we are clearly below 100, and a retest of 100 was rejected. And therefore, the dollar remains essentially weaker. And, the rate hike prospects is obviously driving the markets. And I think this slow shift in the range toward the downside is what we are going to see. Currently, it's not a very liquid market also. So that's what we can see even from the movements, that either we have a very drastic reaction or we have no reaction. That's the kind of market that we are seeing as well. Stock market, it was a mixed reaction, because last week was a very good very good week for both S&P 500 and Dow, even the Nasdaq also. They all went up substantially, particularly driven by good earnings reports as well as the oil price coming down. But now economy's performance is something that market will watch out. This week's inflation number expected to rise a bit, obviously, because last month's number was factoring in a drastic fall in the oil price, and that is not going to be there anymore. So overall, we are watching the Fed rate hike probabilities will be the focus for the markets in the coming days, based on the inflation number that we'll be seeing as well. Now, for India, again, 95 not breaking. For several reasons, because we have seen bids, particularly from PSU banks, which normally, is associated with RBI absorbing the flows. And normally, when they do come in for bids, the market eventually squeezes up. So importers are, more active, and exporters are cautious. Sellers are really cautious. This is despite the fact that we have had modest inflow for equity market as well. And then the oil, again, Middle East situation is continuing to be uncertain. We do not know if it will flare up again or if there is an agreement. The oil prices could come down again as well. Then the issue of fresh tariffs on India and China, because no, the rumor or unofficial reports suggest that because US is not able to supply arms to Ukraine, they are using pressure tactics on Russia not to be able to fund their war by stopping the importing countries like India and China through higher tariffs. So that is what is being talked about in the market. So uh, don't know if the Senate has approved the bill to impose tariff, but it is for the president to finally sign, the order which will impose the tariffs. So that sword is hanging on Indian markets as well. India also has its inflation numbers ahead this week. Again, slightly expected to rise because we are having the impact of food price inflation as well as the retail prices of fuel that has been raised by the government in the last 2 months. So I expect rupee to be well supported at 95 again. At 95.50 test can happen. It's worth mentioning about gold because gold has had more than 9% rise from the lows of 3950, almost 4,370 was seen. Quite a few factors were helping gold. One is because the moment the expectation of rate hike by US is coming down, the fears of the real interest rates going up has now receded. That was driving the gold lower. Market was quite a bit short. There was a short squeeze once the 4,200 mark was taken out as well. And then essentially the dollar weakness is also helping the gold. We had other precious metals also rising. So I think we had 1 week of good performance by the precious metals. Whether we see a renewed bull trend is something that the market will be watching out. Very difficult to get long around 4,350, 4,400 long, but a correction would probably see whether bulls regroup themselves there, or it is a sharp correction that once again leading to a consolidation range. So that is an interesting part that we will be watching in gold. Overall, it's going to be an interesting week, more data to look forward to, and also news from the Gulf. Thank you.
Thank you, Jack. And yes, a lot to look forward to. Of course, we discussed the NFP numbers in detail alongside the reason why unemployment rate was also lower. It's not because that the job market is doing well, it's because the participation rate has gone down. So overall, it was a weak print. We have got CPI and PPI this week to look forward to. We are expecting a slight bit of rise in the inflation figures, partly because the last prints had reflected the fall in oil prices, which has again recovered because of the geopolitical uncertainties. But overall, after last week, we stand at a rate hike probability of 45% for the September meeting. This was, I think, just over 70% a few days back. So there's been a sharp pare down of rate hike expectations. Yields had come down, but they again recovered largely across the curve. Geopolitics, it's still a mess. There's a talk about Oman and Iran managing the strait. A deal might come through that. Dollar index came lower, moving clearly below 100. But it's making, as JK mentioned, a baby step lower. And dollar rupee could not break below 95 sustainably. RBI is absorbing the flows. It is importer buying. Exporters remain cautious. And oil and the tariff issue, it sort of keeps the dollar buyers active. That's it from us today. Thanks for listening. We will catch up tomorrow with a fresh round of updates.